capital budgeting decision ended the explanation in our last class. Today, our focus is on calculations. All what we are going to do today and the next class will be for mainly calculations. So far, under this topic, we discussed the introduction to capital budgeting. We talked about procedures involved in capital budgeting, decisions of capital budgeting, methods of project evaluation and not discounted cash flow method of return, modified internal rate of return, project duration, discounted payback period, talk about payback period as well as after that we also talk about and then internal rate of return. Then we dissected how to identify relevant cash flow in a question, after which we went to discussing the impact of inflation and taxation in capital budgeting. So, and we ended the discussion of the concepts last week. So today is purely calculation. It's purely calculation. That notwithstanding, if there's anything that is not clear to you based on what we have discussed so far under this topic, you can always raise your hand to ask your question. So without further ado, let's go ahead and commence the calculation for today. I would have loved to solve this illustration number 1 because it looks very simple, but examiner hided some things. Examiner, there are some things that was hidden. Okay, so but let me see. Let's start with this illustration number 3. So possibly we do this illustration number 3 because I don't want to solve more than 4 illustrations because of time. So we'll do this illustration number 3. Then we do illustration number 7, which is more like performance management. And then I have another question that includes project-specific, modified internal rate of return, and then NPV embedded in the same question. So it's not in this material. We're also going to solve that one too. Let me see. Possibly I may add this illustration number 6. Okay, so just to make it 4. Then if you still have time, I can add one smaller question to it. Okay, but for now, let the class begin. I need one of you to be our caster for today. I don't mind having international caster like BBC, Sky News. Let me know among you who will help us to read. Yes, who is helping us? Yes. If you can't have international caster, can we have a local broadcaster? Yes, who is helping us? Okay. If no one is willing to take the lead, maybe
Okay, let me
I
read.
have to use in-house
Washington
resource
PLC.
to do the
Let me
reading.
read.
All right.
Okay. Illustration 3. Washington PLC
Okay.
is considering a project, whether
Go
or not
ahead.
to commercial.
Go ahead.
Can you hear me? Okay. Washington PLC is
Go ahead.
considering. Okay. Washington PLC is considering a project, whether or not to commercialize an innovative muscle toning device (MTD) that will be used in the treatment of sporting injuries. It is expected that the commercial life of the MTD will be 4 years, after which technological advances will bring more sophisticated devices to the markets, and the sales of MTD will fall to virtually zero. 8 million naira has been spent in developing and testing the device over the past year. Initial market research has been conducted at a cost of 2.5 million naira and is due to be paid shortly. Information on future returns from the investment has been forecast to be as follows. Selling price inflation rates and fixed cost inflation are expected to be 5% per year, and variable cost inflation is expected to be 4% per year. Fixed costs represent incremental fixed production overheads, which are wholly attributable to the project. The production equipment for the new device would cost 120 million naira, and an additional initial investment of 20 million naira would be needed for working capital. The equipment is expected to be sold at the end of 4 years for 10 million naira when the production and sales cease. The average general level of inflation is expected to be 3% per year, and working capital would experience inflation of this level. Please scroll up. Capital allowances, tax allowable distribution of 25% on a reducing balance basis could be claimed on the cost of equipment. Profit tax of 30% per year will be payable 1 year in arrears. A balancing allowance would be claimed in the 4th year of operation. Washington PLC has a real cost of capital of 7.8%. You are required to A. Calculate NPV, IRR, and discounted payback period, 22 marks. On the basis of NPV, advise if the project should be considered, 3 marks. C. What are your assumptions on the calculation above, 5 marks? Thank you.
All right, thank you very much. Yes, that is the question. In the A requirements, you have to calculate NPV, IRR, and then discounted payback period. So without wasting more time, I will stop sharing this and then move to the working note so that within the next few minutes or thereabouts, we'll be able to complete the question. Okay.
Nintendo. Come.
Everyone, please mute. Please mute. Okay. All right. The name of the company is Washington PLC. This is solution to illustration number 3. Page, I think that's page 46. All right. Page 4. PLC. Requirement number A1. We're asked to calculate net present value, if you like, we can restrict our numbers to million or thousands so that to make our work or your easier. Okay, so this itself has been you are in the examiner asks you to calculate net present value, internal rate of return, and then the discounted payback period. So we want to calculate net present value. What are you supposed to do? We have a format. In this particular question, you are given selling price, you have variable cost, you have incremental attributable fixed cost, okay? You are given taxation, you have inflation, you have scrap value, you have working capital. These are multiple variables. When you have multiple variables and you want to calculate net present value, you have to use the columnar format, all right? You have to use the columnar format. Therefore, from that format that I gave to you last week, you are starting from sales value. You want to determine sales. What are you supposed to do? You go to the question, am I given selling price? Yes, there's a selling price. Okay, is there any inflation? Is inflation going to affect the selling price? Yes, there's inflation. Then you inflate the selling price. You multiply with number of units sold. Then you get your sales, you come and post. Then you go back to the question, are you given variable cost per unit? If yes, is there any inflation rates attached to variable cost? Then you inflate the variable cost. You multiply with number of units produced. Then you get your total variable cost. You come and post. You go back to the question, do you have direct, specific, attributable, or incremental fixed cost? If any one of them, is there any inflation rate attached to it? If any, then you inflate the fixed cost, then you come and post. Yes, Timileyin, go ahead. Timileyin, go ahead quickly.
Yes, maybe it's just me, but you're a bit fast.
I'm a bit fast, okay?
Yes.
All right, thank you. Noted. So, once you have inflated all relevant cash flows, the next thing you are going to do is to determine the profit. So once you get the profit, then of course you are supposed to pay tax. Then you apply the company tax rates on the taxable profits. You consider your tax saved on capital allowance, okay? If there's any scrap value or sales proceed, you also include that. You include your initial cost of the project. If there's any working capital, you have your net cash flow. You discount the net cash flow with the appropriate cost of capital. Then thereafter, you get your present value. Once you get your present value, you have gotten your NPV, because we said NPV represents the difference between the present value of cash inflow and the present value of cash outflow. That's all you need to do. Quickly, let's go to the question and solve it together. So I will then go back to the question. I want to know, what's the useful life of this project? According to the question, you are told that the project has 4 years life. After I've identified the useful life of the projects, I also need to go back to go and check the tax will be paid in the current year or tax will be paid 1 year in arrears. So according to the last paragraph in the question, you are told that profit tax of 30% per year will be taxed in year 2. Profit of year 2 will be taxed in year 3 to the final year results. That means the profit of that year 4 will be taxed in year 5. So it will extend to the 5th year. In this case, I can then say year 0, year 4, year 5. Then, if I like, I can introduce working. Okay. Now, the first item based on the format is sales value. So we need to go and determine our sales. Let's say this first page will be for NPV calculation, followed by the internal rate of return and then the discounted payback period. Then let's go to the 4th page for our workings. All right, so working, before that, I need to indicate the years. So we have years 1, 2, 3, and then 4. Units. According to the question year 1, the number of units given in year 1, unit demanded 20,000, 70,000, 125, then 20. Here is 20,000, 70,000, 125, then 20,000. Okay. Let's say this is A, then working number 1. I want to determine sales value. How do I get my sales value? I will go to the question, I will pick selling price. The selling price for year 1, according to the question, is 2,000, 2,002, 1,600, and 1,500 for year 2, 3, and 4. Okay? 2,000. The first year is 2,000. 2,200, 1,600, and then 1,500. Now, because in the question we have inflation rate of 5% for selling price, according to the question, you are told that selling price inflation rate and fixed cost inflation rate are expected to be 5% per year. All right. So examiner has told you that this selling price is in current price terms. You know, when I was explaining the concept to you under inflation, I told you that when cash flows are stated in year 1 prices or first year prices, inflation should start from year 2. And I said that the fact that inflation should start from year 2 does not mean that your N is going to be equal to 2. No, you are still going to start from year 1. However, I also prices year 0 prices or current value terms, inflation should start. Question examiner has told you that selling that this is real cash flow. Okay, we are given real cash flow, and you want to convert the real cash flow to money cash flow, meaning that you want to then come here. Here we are given different selling prices. Okay, so I will then come here inflation. You know, when I was explaining the concept, I mentioned to you that cash flow, you are supposed to compound. You will inflate, you will increase your real cash flow to money cash flow equivalent. In this case, you are supposed to say, for example, the money cash flow will then be equal to inflation rate. 1 plus inflation rate raised to power n. Because when you do this, that means we are compounding. So you want to convert real cash flow to money cash flow. And I told you then that I don't usually use this formula because it's implied in the question. You already know what you want to do, so there's no need for you to be writing formula for anything. All right. So the same thing in this particular question we are solving. The selling price given to you is in current price terms. That means they are real cash flow. So you want to convert that real cash flow to money cash flow. So in this case, what I will just do is to come here. I will say 1 plus, 1 plus R is the, the inflation rate is 5%. So I'll just say 1 plus 5% will give me 1.05. Then because this is real cash flow, we are given this real cash flow is in current price terms. That means inflation must start from year 1. So I would then say raised to power 1. 1.05 raised to power year 2. 1.05 raised to power year 3. 1.05 raised to power 4. Let me rewrite that. Okay, so in this case, I will then bring out my calculator to inflate the selling price. Then say 1.05 raised to power 1 equal multiply by 2000 equal, that's 2100. Okay. Then in year 2, 1.05 raised to power 2 equal multiply by 2200. That's 2426. 2426. The third year, 1.05 raised to power 3 equal multiply by 1600 equal 1852. The fourth year, 1.05 raised to power 4 equal multiply by 1500 equal, that's 1823. 1823. So with this, I've inflated the selling price. This is inflated selling price. So let's say this is B. Then to now get the total sales, our figures are in million. I will then say A multiplied by B. That will give me the total sales. Okay, so let's do that. 20,000 multiplied by 2100 equal 42 million naira. So because our figures are in million, so here will be 42. I want to put our number to 2 decimal place. So 42, here will be 42.00. Then the second multiply by 2426 equal, that's 169,820. 169,820. Last the 170. That's 170.00. Then the third year will then be equal to 1852 multiplied by 125,000 equal 231,500,000. So let's say that's 232. This is 232 million. 232 million. All right, or 230, because we said we want to round our number to 2 decimal place. So in that case, let's redo that. So that's 231.50. Okay, 231.50. 231.5. Then this one too will be 169, because it's good to be consistent. 169, let me do that again. I think 169 point something. 70 multiplied by 2426.
0.82.
So 169.82. Thank you. All right. Then the final year will be equal to 1823 multiplied by 20,000. That's 36.46. Okay, 36,000,046. Now that we have calculated our sales value, so we need to go and post it. The first year is 42. All right. Dash. Here is 42.00. Here is 169.82. And the third year, what's the third year figure?
231.50.
50.
231.50. And the fourth year,
36.46.
36.46. In year 5, put dash. This is working number 1. I will then go ahead and determine variable cost. Let's determine variable cost the same way we did for sales. Working number 2. I want to determine variable cost. All right. So to get the variable cost for the first year, according to the question, is 900, followed by 1,000, 1,020. All right. So year 1 is 900 naira, 1,000, 1,020, and then 1,020. I will go back to the question. What's the inflation rate on variable cost? Variable cost inflation is expected to be 4% per year. 4%. 1 plus 4% will give us 1.04 raised to power year 1, 1.04 raised to power year 3, 1.04 raised to n. I will then say 1.04 from the calculator, 1.04 raised to power year 1 equal to, then multiply by 900. One day we are going to have a better network infrastructure. So here is 936. Then for the second year, okay, 1.04 raised to power year 2 equal, then multiply by 1,000. That's 1082. Here is 1082. Sorry for the break in transmission. It's the same issue. I just changed to another one now. Hopefully it will be more stable. Let's continue, please. Yes, for year 4 variable costs, 1.04 raised to power 4, then multiply by 1020 will give us 1193. Okay, so that's that. Then let's post. Sorry, before that, this is the inflated variable cost. Let's call this one C. So to now get the total variable cost in million naira, we multiply the number of units, which is A multiplied by C. All right. So the first year unit is 20,000. 20,000 multiplied by 936 equal 18,720. This is 18.72. Our figures are in 2 decimal place, million. Then the second year units is 70,000 multiplied by inflated variable cost of 1082 equal 75.74. Here is 75.74. Okay. Then year 3 unit is 125,000 multiplied by inflated variable cost of 1147 equal 143.38. Here will be 143.38. Then year 4, 20,000 units multiplied by 1193 equal 23.86. 23.86. So you call the number for me so that I don't need to be switching up and down. Okay. So the first one is 1872. Let's go and post. Variable cost 18.72. What was the second year?
75.74.
75.74. So cash outflow. Year 3?
143.38.
143.38. Okay. Year 4.
23.86.
23.86. Thank you. So that's that. Then I will go back to the question in case I have any relevant fixed cost. Remember, when I was explaining the concept, I mentioned that there are 3 different ways the examiner can test you on fixed cost. If you are given fixed cost with no further information, no additional information, and I said that that fixed cost is irrelevant because provided your fixed cost will not change, fixed cost is irrelevant cost. Number 2, I said that if you are given a fixed cost that include depreciation, and I also said that fixed cost is not relevant, but examiner wants you to do something. What are you supposed to do? You will calculate annual depreciation and you less it from the fixed cost. Whatever you have thereafter is a relevant fixed cost. Then number 3, I said that if you are given a fixed cost that exclude depreciation, that fixed cost is relevant. You have to include it. So in this question, examiner has told you that after the paragraph immediately after the table, you are told that fixed costs represent incremental fixed production overhead, which are only attributable to the project, which means this fixed cost of 10 million naira per annum is relevant because I explained to you that when you are given direct fixed cost, incremental fixed cost, specific fixed cost, or attributable fixed cost, they are all relevant. You have to account for it. So examiner has told you this fixed cost of 10 million naira is incremental and attributable to the project. That means it is relevant. Now, if that is the case, what's the inflation rate for fixed cost? We are told it is 5%. Inflation rate for fixed production overhead is 5%. So let's go and inflate that. I don't need to go and do working for my fixed cost because fixed cost does not have anything to do with number of units. Therefore, I can just come here to say fixed cost. It's not just fixed cost. If you like, you can call it incremental fixed cost or attributable fixed cost. So I will come here incremental fixed cost. Okay, the inflation rate is 5%. If I want to do this, if I'm the one solving this, I will not do working. This is what I will do. I will say at 5%. That's the inflation rate. So in this case, the fixed cost is in current price terms. That means I have to start inflating from year 1. Therefore, I will then say 10 million naira, that is 10 multiplied by 1.05. This will give me 10.5. I will come here minus 10.5. Our figures are in 2 decimal place. Okay? Whatever I have in my calculator, I will multiply with 1.05. So multiply by 1.05 equal, that's 11.03. Here is 11.03. what I have in my calculator, then multiply by 1.05. This will give 11.58. 11.58. I'll go to year 4. Whatever I have in my calculator, multiply by 1.05 equal, that's 12.16. Here is 12.16. With this, I have inflated my fixed cost. So for the purpose of this class, for your own understanding, let me go down there and do the calculation. Yes, Ufoma, talk to me.
Sir, please, sorry, I want to reconfirm this statement. You said if we are giving current year inflation, inflation should start from the second year, right?
I said if you are given current, if your cash flow is in current value terms, inflation should start from year 1. Okay?
Okay, sir.
So incremental fixed costs. The fixed costs in the first year is 10 million. Our figures are in millions, so 10 million, 10 million, 10 million. Then inflation is 5%. So here will be 1.05 raised to power 1, 1.05 raised to power 2, 1.05 raised to power 3, 1.05 raised to power 4. Okay. So I will then come here, total incremental, this is the incremental fixed cost in million. All right, this one has nothing to do, fixed cost has nothing to do with number of units. So I will then carry my calculator, 1.05 raised to power 1 multiply by 10 will give us 10.5. That's the answer we got up there. Okay. The second year, 1.05 raised to power 2 equal, then multiply by 10. I got 11.025. So here is 11.03. Let me write it. Then year 3. Year 3 will be 1.05 raised to power 3 equal, then multiply by 10 equal 11.57625. So that will be 11.58. Then year 4 will be 1.05 raised to power 4 equal 1.2155 whatever, then multiply by 10. That's 12.1550625. So here is 12.16. So you can see the one that I calculated up there is just one line item. This one is about 3 line items. You are still wasting time on this. I've gone to the next one. So that's why I say I don't need to do working for my incremental fiscal or my fixed cost. All I need to do is to just take the fixed cost, multiply with the inflation rate, and then move on from there. All right, but it's good to do it this way so that you understand what I've done. All right. Okay, let's move to the next one. Now that you have determined the incremental fixed cost, I need to go back to the question in case I have any other relevant cash flows. So there is no other cash flow apart from the initial outlay of 120 million naira, working capital of 20 million naira, and then the scrap value of 10 million naira. Those ones will come much later. Also, when you go to the first paragraph of the question, examiner has given to you 8 million, you are told that 8 million naira has been spent in developing and testing the device over the past year. Initial market research has been conducted at a cost of 2.5 million naira and is due to be paid shortly. So examiner has given you development cost of 8 million naira. So that cost is a sunk cost, all right? Because this cost has been incurred before the project even commenced. Therefore, it is not relevant because your relevant cash flow must relate to the future. Not only that, the market research cost of 2.5 million naira is also a sunk cost. Even though you are told that it's due to be paid shortly, irrespective of when the payment will be made, is a past cost because you are told that the initial market research has been conducted, the activity has been done, okay, the work has been performed, so it's a sunk cost, it's irrelevant. So we ignore the 8 million and then the 2.5 million naira. They are not relevant. So at this point, there is no other relevant cash flow again. Therefore, let's determine the taxable profits. Dash, dash. Then 42 for the year 1, 42 minus 18.72 minus 10.5 equal, that's 12.78. 12.78 is the profit of the first year. I'll move to the second year. In the second year, total sales is 169.82 minus 75.74 minus 11.03 equal. Again, sorry about that for the break in transmission. Let's continue. So 83.05 is the second year, 83.05. Then the third year is 231.50 minus 143.38 minus 11.58 equal 76.54. Then year 4, 36.46 minus 23.86 minus 12.16 equal 0.44. Here is 0.44. Okay. So these are our taxable profit. Immediately after profit, you are supposed to pay tax based on the format I showed you last week. So company tax rate in this question is 30%. Examiner has told us that tax is paid 1 year in arrears. It means that the profit of year 1 will be taxed in year 2. Profit of year 2 will be taxed in year 3. Profit of year 3 will be taxed in year 4. Profit of year 4 will be taxed in year 5. So in this case, I would then say 12.78. 12.78 multiplied by 0.3. That's 3.83. So I will not record it in the first year because tax is paid in arrears. So this is 3.38. Of course, it's a cash outflow. You are paying the tax. The next one, sorry, 3.83. 3.83. Then in the second year profits, second year profit of 83.05 multiplied by 30% equal 24.92. This second year profits tax will be paid in the third year, so 24.92. So I will then go to the third year profits, which is 76.76. 54 multiplied by 30% equal 22.96. 22.96. The fourth year profits 0.44 multiplied by 30% equal 0.13. So in year 5, we are going to pay tax of 0.13. So that's that. Now, immediately after tax liability, you are supposed to claim capital allowance. Therefore, we need to go and calculate tax saved on capital allowance. Tax saved on capital allowance. So let's go and do working for that. Remember, the tax saved on capital allowance must follow the pattern of your tax liability. Your tax liability is in in 1 year in arrears. Then your tax saved on capital allowance must also be 1 year in arrears. So here I want to calculate tax saved on capital allowance. Okay. You already have the format starting from year, narration, cost, then tax saved on capital allowance at 30%. Company tax rate is 30%. Our figures are in million. Okay, you have to be consistent. So year 0, we have the costs. I will then go back to the question, what's the cost of this equipment? I think we are told it's 120 million. Yes, the production equipment for the new device will cost 120 million naira. Okay, that's 120 million naira. Here is 120 million. Okay. Then I need to calculate year 1. I need to calculate capital allowance. In this question, you are not given initial allowance rates. So you only calculate for annual allowance for the first year. So here will be annual allowance. The tax depreciation allowance given to us is 25%. So multiply by 25%. What's 25% of 120? So from your calculator, 120 multiplied by 0.25 equal, that's 30. 30 minus 120 will give us 90. So this 90 is the tax written down value at the end of year 1. I will then move to year 2. I will calculate annual allowance. Remember, annual allowance is the allowance claimable every year until the final disposal of the assets. So every year you are going to be claiming this 25%. So what's 25% of 90? All right, 90 multiplied by 0.25 equal 22.5. Here is 22.5 minus 90 will give us 67.5. All right, so this represents tax written down value at the end of year 2. I will then move to year 3. Annual allowance at 25% of 67, okay, 0.25 multiplied by 67.5 equal 16.88. Here is 16.88 in 2 decimal place. All right, so 16.88 67.5 minus 16.88 equal 50.62. So this represents the tax written down value at the end of year 2. Remember, the useful life of this equipment is 4 years. So the 4th year is the final year. So in this case, you need to compare the tax written down value of year 3 with the sales proceed of year 4, whether it will result in balancing allowance or balancing charge. So I will then come here, scrap value according to the question, we are told that this equipment will be disposed of for 10 million naira. Okay, the equipment is expected to be sold at the end of 4 years for 10 million naira when the production and sales cease. So 10 million naira, so here will be 10. So you less. The difference is that will be 40.62. Here is 40.62. I said that if the tax written value is higher than the sales proceed, the difference is called balancing allowance. Okay, this is balancing allowance in year 4, which is the final year. All right. But if tax written value is less than the sales proceed, the difference is called balancing charge. All right. So, but this one is balancing allowance because 50.62 is higher than 10 million. Okay, so that is the balancing allowance. Now, I told you also, the essence of capital allowance is to reduce taxable profits and in effect, tax liability. So you are supposed to claim capital allowance when you incur qualifying capital expenditure in order to reduce your tax liability. So I can either use capital allowance to reduce my tax liability, or I use tax saved on capital allowance to reduce my tax liability. Whichever one I do, I'm going to get the same answer. However, one is faster than the other, and that's what I always advise you to use tax saved on capital allowance to reduce your tax liability. If I want to use capital allowance, for example, I've already calculated my capital allowance to be this, to be this, to be this, and the last one. So if I want to use capital allowance to reduce my tax liability, I will go and pick my profit for each year. Once I will go and calculate my tax liability separate. So I'll bring out the profit for each year. I will less all this capital allowance. Okay. Then whatever I have thereafter will then be my taxable profit. I will then apply 30% tax rate on them to get my tax liability. I will go and post it. But I don't want to follow that route. I'm using tax saved on capital allowance. So in this case, to get my tax saved, I need to multiply the company tax rates on the capital allowance for each year. So in this case, the first year capital allowance is 30. So I will say 30 multiplied by 30%, which is 0.3. That's 9. So tax saved on capital allowance in the first year is 9. All right. Then I will go to the second year. Capital allowance is 22.5. 22.5 multiplied by 0.3 equal, that's 6.75. Here is 6.75. In the third year, 16.88. 16.88 multiplied by 0.3 equal 5.06. Here is 5.06. And the final year, which is year 4, 40.62 multiplied by 0.3 equal, that's 12.19. Here is 12.19. Okay. Now you need to confirm, because you must ensure that you don't claim beyond the capital allowance claimable. So first thing first, you need to determine the total capital allowance you are supposed to claim. So this should be the total tax saved. This total tax saved is the total capital allowance you are supposed to claim on the assets. So in this case, you need to confirm if you have not claimed beyond what you are supposed to claim. So first thing first, I will add up. This is 9 plus 6.75 plus 5.06 plus 12.19. This gave us 33 million. So the total tax saved is 33 million. That's total capital allowance the company is supposed to claim. So I need to confirm that I have not claimed beyond what I'm supposed to claim. So to do this, The formula to use we are going to use to confirm is cost minus this disposal value or scrap value multiplied by company tax rates. So the cost of this equipment is 120 million. Scrap value is 10 million. Company tax rate is 30%. All right. So 110 multiplied by 30% will give us 33 million. So with this, I'm rest assured that I have not claimed above or below the actual capital allowance. So with this, let's go and post. The first year is 9, followed by 6.75. So again, like I said, it must follow the pattern of your tax liability. So the capital allowance in the first year will be claimed in the second year. So here will be 9. You are claiming it, so you don't put it in brackets. So you are claim. That will reduce your tax liability. Here is 6.75. What about the third year? Capital allowance, tax saved. Are you still
5.06.
5.06? Thank you. The fourth year,
12.19.
12.19. Thank you. That's working number 4. Now, after tax saved on capital allowance, we consider scrap value. Scrap value is 10 million naira, which will occur in the final year, which is year 4. Here is 10 million. Please, you have to be very careful. You notice that the useful life of this equipment is 4 years. So the useful life of the project is 4 years. So your scrap value is supposed to be in the final year, which is year 4. But because of tax, we have extended the year by 1 because of impact of tax. So if you are not careful, you will be thinking that your mind might not be there. This scrap value of 10 million, you can mistakenly put it in year 5. So you have to be very careful. The reason why we extend to year 5 is because of tax. All right. So the useful life of the project generally is 4 years. Okay. So that's that. Then the next item from our format is initial outlay. The initial outlay is 120 million. It's a cash outflow, so you put it in bracket. Then we're also given working capital in the question. Now, let's go back and calculate our working capital. Okay? According to the question, you are told that the company will require a working capital of 20 million naira. Let me go back to the question. Yes, and an additional initial investment of 20 million naira will be needed for working capital. The equipment is expected to be so blah blah blah. Then the average general level of inflation is expected to be 3% per year, and working capital would experience inflation of this level. So meaning that this 20 million naira working capital should be inflated by 3% per annum. So now you need to establish from the question, this working capital, is it in current price terms or in year 1 prices? Examiner is silent. You are not told whether this 3 million naira is in current price terms, like you have for selling price, variable cost, and fixed cost. So examiner did not tell you it's in current price terms, but examiner has told you in the question that the average general level of inflation is expected to be 3% per year. All right. So which means that 20 million naira is 4 years, is the first year price. So if 20 million naira is the first year price, then inflation should start from year 2. So in this case, I need to go and inflate the working capital. So I can come here, working number 5. Working number 5, working capital. So we have year 1, year 2, year 3, and then year 4. So we can create a column for total. Our figures still remain in million. All right. So working capital. So of 20 million, if I want to use primary school method, I will just repeat 20 million for each year. Then we have inflation. Inflation at 3%. I'm coming for you, Dami. So since inflation is 3%, I would then say 1.03 raised to power 0. This 20 million naira is in first year price. That means inflation should start from year 2. So I would then say 1.03 raised to power 1, 1.03 raised to power 2, 1.03 raised to power 3. I've told you already, the fact that I said inflation should start from year 2 does not mean your n is equal to 2. Okay? So meaning that the first year price given to you, you are not going to inflate it. It will be the same price. It will still be the same value. So you are going to start inflating from year 2. All right? So before I get my answer, let me allow Dami. Dami, talk to me.
Good evening, sir. So my
Yeah.
question is on the working capital, the inflation. Please, can you explain why we're starting from year 2 again, the inflation part?
Why?
We're starting from year 2. Inflation starts from year 2.
Yes, the working capital, you are told in the question that the company will incur additional investment on working capital of 20 million naira. So that 20 million naira, examiner did not tell you that whether it will be in current price terms or in first year price. Examiner is silent because you must know, if you are not told, you won't know when to inflate the cash flow. All right. So in this case, since examiner is silent, number one, you may assume that is in the first year. But number two, because the examiner told you that the average general level of inflation per year is 3%. So you have given inflation for each year to be 3%. So that what that means is that that 20 million naira is the first year price. So if it's the first year price, you need to start inflating from year 2, meaning that the first year price of 20 million naira, we are not going to inflate from if it is in current price terms, you are going to start inflating from year 1. But because it's in first year price, so that first year price is your base year price. So you need to start inflating from year 2. And I also said that the fact that I said you are supposed to start inflating from year 2 does not mean that your n is equal to 2. Your n will still remain as 1, just the way I've done on the screen. All right. So that is my explanation on that. Dami, is it understood?
Yes, sir. Thank you, sir.
You're welcome. Yes. Who has consulting? Talk to me.
Sir, okay, just to quench my curiosity, sorry to say this, the inflation, I noticed that you
Yeah.
said 1.03 is about 0.
Yeah.
Like, I was like, why is it 1.03 is about 0? Unlike the others, where the others that we did, for year
Yes.
1, it was 1.05 is per 1 from the first year.
Yes,
But
what
this,
you need to understand is that the first one that we solved, they are in current price terms. If they are in current price terms, inflation should start from year 1. And that's why when you look at the variable cost, even the fixed cost, the selling price, we are putting year 1, year 2, year 3 because they are in current price terms. If they are in current value terms, you need to start inflating from the first year. But if they are in first year prices, inflation should start from year 2. And that's why this working capital you are seeing here is in first year price. It's not the same thing as current price terms. That's why I was particular when I was giving you the note that note the following. When cash flows are stated in first year prices or year 1 prices, inflation should start from year 2. And I said that the fact that inflation should start from year 2 does not mean that your n is equal to 2. Then number B, when I was explaining the concept, I also mentioned that when cash flow are stated in today's prices, year 0 prices, or current value terms, inflation should start from year 1. So that's different between the two. This working capital now is in first year price because your general inflation per year is given to you. So if that is the case, you are not going to inflate year 1. This 20 million naira in year 1, you are not going to inflate. It will remain as 20 million. So, and I said the fact that the fact that I said your inflation should start from year 2 does not mean your n is going to be n is going to be 2. 2, 3, 4, 5. No, you are going to start from the beginning. For example, now 1.03 raised to power 0 multiplied by 20 will give us 20. That means the first year price has not changed. It still remains the same.
Okay.
So for the second one, I will say 1.03, okay, 1.03 raised to power 1, which is, of course, 1.03 multiplied by 20. That is 20.6. You can see now it has changed, 20.6. I will then go to year 3. I'm coming for you, Minister of Finance. 1.03 raised to power 2. Okay, then multiply by 20. This is 21.22. Here is 21.22. The fourth year, 1.03 multiplied by raised to power 3 equal, then multiply by 20 equal 21.85. Here is 21.85. Okay, so that is what you are going to do. This is the way you are going to do it. If cash flows are stated in first year price, you can see that I said you should start inflating from year 2. You will notice that year 1 cash flow of 20 million still remain the same. Even after our inflation, it still remain the same. But from year 2, you can see that it has increased for year 2, increased for year 4, year 3, and then year 4. So this is what I mean by inflation should start from year 2. Okay? Now, Minister of Finance, talk to me. You raise hand.
Yes, sir. I want to clarify that will examiner always specify whether current price term or current or the second statement? Didn't get it. So would they
Whether
always
it's first
specify
year,
per
of
time?
course, it will be. You are going to see it in the question. If your examiner did not tell you, that means you are going to assume it's in first year price. Okay, so if you are going to be told in the question whether it's the first year price, year 1 price, or current value time, or today's price, examiner will surely tell you how the kind of prices that you have. But the bottom line is that, and that's why I was specific on how you are going to treat it when you see it in a question. Don't worry, as you proceed, you are going to see different examples. All right.
Thank you, sir.
Okay. You're welcome. So now you can see that our working capital has increased from the first year 20 million to the fourth year of 21.85. Therefore, we need to calculate, you need to determine incremental working capital. You remember when I was explaining the concept, I told you that working capital is relevant and should be treated as follows, depending on whether it's a one-off working capital or incremental working capital. And I said that incremental working capital should be treated as cash outflow in the year before the year of occurrence and recover fully at the end of the useful life. So as far as incremental working capital is concerned, only the increment should be considered. Therefore, I would then say incremental working capital. What has changed? The first year working capital is 20 million. Okay. From 20 million, it has increased to 20.6, difference of 0.6. So from 20.6, it has increased to 21.22 minus 20.6. So with a difference of 0.62, 0.62. Then from 21.22, it has increased to 21.85. So I would then say 21.85 minus 21.22. Here I have 0.63, 0.63. So I will add up everything. The highest working capital is 21.85. That's the highest. Okay, so when you add up 20 plus 0.6 plus 0.62 plus 0.63, we are going to have the same thing as 21.85. Okay, and then the rule says working capital should be treated as cash outflow in the year before the year of occurrence and then recover fully at the end of the useful life. Therefore, I can then come here, relevant year. Now, the 20 million that occurs in the first year will be treated as cash outflow. Year before year one is year 0. The 0.6 increment of year 2 will be treated as cash outflow in year 1. The 0.62 of year 3 will be treated as cash outflow in year 2. The 0.63 of year 4 will be treated as cash outflow in year 3. Then at the end of the useful life, which is year 4, we are going to recover the entire working capital. So this is how to treat incremental working capital. I will then go and post. I have 20 million, 0.6, 0.62, then 0.63. Okay, let's go and post. Working capital, the first year 0 is 20, 0.6, 0.62, 0.63. Then in year 4, we recover everything, which is 21.85. So this is working number 6, I think. Number 5. Okay, number 5. Okay, so after this, we need to determine the net cash flow. So the first year 0 is 140 million. This is net cash flow. So with this net cash flow, you can calculate anything. You can use any technique to determine the financial viability. So I have 12.78 minus 0.6 equal 12.18. Then year 2, 83.05 minus 3.83 plus 9 minus 0.62 equal 87.6. Okay. Then year 3, 76.54 minus 24.92 plus 6.75 minus 0.63 equal 57.74. Okay. Then year 4, 0.44 minus 22.96 plus 15.06 plus 21.85 equal 14.39. Then year 5, 0.13 minus or 12.9 or 12.19. That will give us 12.06. Here is 12.06. So this is our net cash flow. So like I said, with this net cash flow, I can use any technique, including NPV, IRR, payback period, discounted payback period. I can use project duration, modify internal rate of return. The only technique that I I was taking out. Okay. So now we have calculated our net cash flow. So we need to discount this cash flow with the appropriate cost of capital. So I will then go to the question, what's the cost of capital given? According to the question, you are told that Washington PLC has a real cost of capital of 7.8%. Pay attention to this. You have been given a real cost of capital of 7.8%. You remember when I was explaining the concepts, I said you have to give apple for apple. Money cash flow for money cost of capital. Real cash flow for real cost of capital. You cannot use money cash flow for real cost of capital. Neither can you use real cost of capital for money cash flow. So according to this question, you have been given real cost of capital of 7.8%. I cannot use that 7.8% for this cash flow because the cash flow we have calculated are money cash flow. I cannot use real cost of capital for money cash flow, so I have to convert it to money cost of capital first. Therefore, I will then go back and do my workings. So that will be working number 6. Okay, working number 6, I want to calculate money cost of capital. M. All right, of course, like I explained, you are supposed to use Fisher effect formula to get your money cost of capital. When I was telling you this last week, I said just memorize the formulas, the 3 of them: money cost of capital, real cost of capital, general inflation rates, using the Fisher effect. Once you know the formula you are supposed to use for money cost of capital, real cost of capital, you are good to go. So according to Fisher, money cost of capital is equal to 1 plus real cost of capital multiplied by 1 plus general inflation rates, all minus 1. So this is the formula for calculating money cost of capital. Therefore, M is equal to real cost of capital in this question is 7.8%. So that will be 1.078. General inflation rate we are told is 3%. So that will be 1.03 or minus 1. So M, mathematically, M will then be equal to 1.78.
Sir, is
I've
that
told you,
R
don't just talk
in the
appropriately.
second
Raise your
bracket?
hand anytime you want to talk, right?
Sorry, sir.
The second bracket is not R, it's I, general inflation rates. This is I. Is that what you are asking?
Yes, sir.
Think is that Ufoma or Charity? Charity, you are the one, right? Okay, let's move on. So I will then say 1.078 multiplied by 1.03 equal minus 1 equal multiplied by 100%. That gave us 11.034. Rounding, this is approximately 11%. So money cost of capital is approximately 11%. So we are going to use 11% to discount the cash flow. So I will then come here. Here is 11%. Discount factor for year 0 is 1. Discount factor of year 2 at 11% will give us 1.11 raised to power 1 minus equal 0.901. Here is 0.901. Then for year 2, this will be 1.11 raised to power 2 minus equal 0.812. 0.812. Year 3, 1.11 raised to power 3 minus equal 0.731. Then year 4, discount factor 1.11 raised to power 4 minus equal 0.659. 659. Year 5. Year 5, 1.11 raised to power 5 minus equal, error. 1.11 raised to power 5 minus equal 0.593. Here is 0.593. Of course, our cost of capital is working number 6. So at this point, I need to calculate the present value. I need to determine the present value. So here we still remain as 140 negative. Here is present value. Here will be net present value. Okay. All right. So for year 1, PV of year 1 will be 12.18 multiplied by 0.901. That's 10.97. Here is 10.97. Then year 2, 87.6 multiplied by 0.812 equal 71.13. 71.13. Then year 3, 57.74 multiplied by, 57.74 multiplied by 0.731. That's 42.21. 42.21. Then year 4, 14.39 multiplied by 0.659. Okay, equal 9.48. Year 5 will then be equal to 12.06 multiplied by 0.593 equal 7.15. Here is 7.15. So to now get the NPV, we are supposed to add up. We said that NPV represents the difference between the present value of cash inflow and then present value of cash outflow in capital investments. So you are supposed to start from the positive cash flows. So I would then say 7.15 plus 9.48 plus 42.21 plus 71.13 plus 10.97 equal then minus 140 equal 0.94 positive. 0.94 is the net present value. Okay, so examiner did not ask you to advise. In the A requirements, you only has to calculate NPV. Therefore, our NPV is approximately 940,000 naira. That is NPV. So let me know if you have any question based on what we have calculated so far. Let me know if you have any question or any concern before we calculate the internal rate of return. Quickly, talk to me. 1 minute. Any question? If there's none, then we'll proceed to A2. Requirement A2. we want to calculate internal rate of return. Calculating internal rate of return, IRR. We said that internal rate of return is the rate that equates the NPV to 0, or the rate that equates the present value of future cash flows and present value of cash outflows to 0. Okay? So if that is the case, what are you supposed to do when you are calculating internal rate of return? Simple. I told you to assume two discount rates that will produce two opposing NPV. One discount rate will give you a positive NPV. Another discount rate will give you a negative NPV. Then step 2, you proceed to calculating the internal rate of return using IRR formula. Then step 3, you advise. But in this case, you are not asked to advise. Therefore, we are going to assume two discount rates. Our focus is that since we have calculated NPV before, we got 0.94 using 11%, so we can increase our discount rate to give us a negative NPV. If we like, we can increase to 13% or 15%. We are going to get negative because this 0.94 is closer to 0. So any rates above this 11%, you are going to get a negative NPV. But in order to minimize our iteration, we can use 13% or 15%. Let's use 15%, we are good. So I can then come here, I will say assume 15%. So we are going to use this 15% to calculate NPV. If I like, I can use columnar format. If I like, I can use normal formats we use for NPV. If I want to use the normal formats, it is still the same thing. I will just come here, create a column for year. I don't need description of item. All right, I will just put cash flow. In this case, to be our net cash flow we have calculated before. Then we are going to have discount factor at 15%. Then the present value, that's all. Year 0, year 1, year 2, year 3, year 4, then year 5. The net cash flow in year 0 is 140 million. Okay? Net cash flow in year 1, based on the NPV we have computed, is 12.18. Here is 12.18. Net cash flow in year 2 is 87.6. 87.6. Then the net cash flow for year 3 is 57.74. 57.74. Let me do that. Then in year 4, 14.34. 14.34. Then year 5, 12.18 or 19. 12.06 is the net cash flow, 12.06. Okay. Now, discount factor at 15% for year 0 is 1. At 15%, discount factor for year 1 will be 1.15 raised to power 1 minus equal 0.87. Here is 0.870. In year 2, 1.15 raised to power 2 minus equal 0.756. 0.756. Year 3, 1.15 raised to power 3 minus equal 0.658. 658. Then year 4, 1.15 raised to power 4 minus, that's 0.572. Year 5 at 15%, 1.15 raised to power 5 minus equal 0.497. 497. So we then determine our present value. Here will be 140 negative. Let me write it. Okay. Then here one present value, 12.18 multiplied by 0.87. That's 10.60. Here is 10.60. Year 2, 87.6 multiplied by 0.756. That's 66.23. Year 3, 57.74 multiplied by 0.658 equal 37.99. Okay. Then year 4, 14.34 multiplied by 0.572 equal 8.20. Finally, year 4, 12.06 multiplied by 0.497 equal 5.99. 5.99. Minister of Finance, talk to me, please.
Sir, year 4 is 14.39.
14.39.
The cash flow.
Oh, error of mind. Thank you. 14.39. Thank you. That's how student made mistake. Oh, you won't know. You think you are picking the right number. That's why it's good. Once you have picking the figures, you have to cross-check again before you conclude and move to the next one. Otherwise, you might have made mistake. You won't know. Just the way I made now. 14.39 multiplied by 0.572. That's 8.23. That 3 is a big difference. Big difference. Okay. Now, what's our NPV? What's our NPV? So, I have 10.6 plus 66.23 plus 37.99 plus 8.23 plus 5.99 equal 129.04 minus 140 equal 10.96. Here is 10.96 negative. You can see that our NPV is big now. If you will use anything from 12%, we are going to have negative NPV. All right. So step 2 says you should calculate internal rate of return using IRR formula. Therefore, lower discount rate plus the NPV of the lower discount rates over NPV of the lower discount rates plus NPV of the higher discount rates, all multiplied by higher discount rates minus lower discount rates. So our internal rate of return, we assume 15% and then 11%. 11% is lower, so here will be 11 plus NPV of 11.94 divided by 0.94 plus NPV of higher discount rates, which is 10.96. Okay, so multiply by higher discount rate of 15 minus lower discount rate of 11. Okay. Finally, internal rate of return will then be equal to, I will start from the parentheses. The denominator is 0.94 plus 10.96 equal, I have 11.9, therefore 0.94 divided by 11.9 equal, then multiply by difference between 15 and 11, which is 4, plus 11. 11.32 is the internal rate of return, 11.32%. So finally, we have to calculate discounted payback period. So A, Roman figure 3, calculating discounted payback period. Okay. Before we move to discounted payback period, please let me know if you have any concern or question on the internal rate of return we have calculated. If not, then we proceed. Now, we want to calculate discounted payback period. In my explanation to you last week, I said that discounted payback period is calculated the same way as the normal payback period, except that the future cash flows are discounted to the present value equivalent before calculating the payback period. That is, when you want to calculate discounted payback period, you are supposed to use present value to recover the initial investment instead of using normal future cash flows. You are not going to use that. You are going to use present value to discount the future cash flow. So in this case, if I like, again, I can use columnar format. If I like, I can use regular formats to calculate my discounted payback period. I will still get the same thing. But to make life easy for you so that you don't make mistake on the day of your exam, so let's use the normal formats. So to calculate the discounted payback period, I will create a column for year, cash flow, then present value. There's no need for me to put discounting factor again, because when I calculated the NPV, I've already calculated present value. Okay, we have already calculated present value, so I don't need to go and recalculate it again. All right, so I will just pick the present value for each year. But if I have not calculated present value before, immediately after cash flow, I will put discounting factor, I'll put discount factor, I'll put column for present value, then I'll put column for cumulative. But since I've calculated present value, I don't need to stress myself here. I will just come a PV, then cumulative balance. Okay? So year 0, year 1, year 2, year 3, year 4, and then year 5. The year 0 cash flow is 140 million. Year 1 cash flow. The net cash flow in year 1 is 12.18. That's 12.18. In fact, I don't need to, in fact, all this one, I'm just stressing myself. Let me just use the present value. I don't need normal cash flow since I'm not discounting. I'm not using, I've already calculated the present value. So I will just call me a present value. Don't need to stress yourself. Then we have cumulative. So here is 140. Present value of year 1. Present value of year 1 is 10.97. Here is 10.97. Okay. Present value of year 2. Please be calling the number for me. Present value of year 2 is 71.13. So that I don't need to be flipping pages. 71.13. What's present value of year 3?
42.21.
Okay. Year 4,
9.48.
and then year 5,
7.1.
7.15.
7.15. So those are the present value we have calculated previously. Now, what I'm trying to say in essence is that if in the question you have not calculated present value before and you are now asked to calculate discounted payback period, first thing first, you are going to create a column for number of years. You create another column for cash flow. You create another column for discount factor. You create a column for present value. Then you create a column for cumulative. In this particular instance, the question we are solving, because we have calculated present value before, that's why I skipped the cash flow and the discount factor because I already have present value. So I don't need to be doing all of that because it will waste your time on the day of your exam. Once you have calculated NPV previously and you are now asked to calculate discounted payback period, just pick the present value you use in your NPV calculation and that's all. So here still remain as 140. So we want to recover. You are supposed to use the present value to recover the initial investments. So we are starting with 140 million minus 10.97 equal 129.003. Here is 129.03. At the end of year 1, we have recovered 10.97. We are left with 129.03 to balance to recover. So whatever I have in my calculator minus 71.13 equal 57.9. Here is 57.9. So we have a balance of 57.9 to recover, minus the next cash inflow of 42.21. So we have 15.69. 15.69. 15.69 minus minus 9.48 equal 6.21. Here is 6.21. So because 6.21 is less than the next cash inflow of 7.15, we are going to put a dash and then calculate the payback period. I will then say discounted payback period equal to how many years have we recovered? We have recovered for 4 years. So here will be 4 plus the outstanding balance of 6.21 over the next cash inflow of 7.15. So I will then carry my calculator. 6.21 divided by 7.15 equal, then plus 4 equal 4.87. Here is 4.87 years. So the discounted payback period is 4.87 years. That's the answer. All right, that's the answer. So let me know if you have any question under the discounted payback period. If not, then we'll proceed to number B requirements. I want to see if you can add one more illustration. Okay. So in number B requirement of the question, the examiner is asking you, on the basis of NPV, advise if the project should be considered. All right, this is a bonus 3 marks. So if that is the case, we have calculated NPV, and the NPV give us, we have a positive NPV of 0.94. Based on our explanation, we say under the decision rule, we said that for independent projects, except if NPV is positive. You can see we have calculated a positive NPV of 0.94, which means that the project is financially viable. So in that case, I will then come here, number B. Number B, requirements, advice. Okay. The projects produced a positive net present value of 0.94 million naira. Therefore, the project is financially viable. Financially viable and should be considered or undertaken and should be considered. That's all. That's all you need to do. However, you will never earn your full mark if you don't state your assumptions. Okay? We have an assumption we've made in our calculation, for example. In fact, from the first one that we solved, this NPV, we are supposed to state our assumption. All right, but that notwithstanding, we can still do it under here. So you need to state your assumption because there are some figures in the question whereby which you ignore. Where did you ignore them? So you must state it. So you can say the calculation above is based on the following assumptions. So whenever you want to state your assumption, always start with cash flow. Okay? We talk about cash flow. What are you going to say what are you going to say under cash flow? You say that it is assumed that, let me put it down for you. It is assumed that the cash flow estimates are realistic. Use the selling price, the variable cost, the fixed cost, they are just estimate, they are not actual cost. So our assumption is that the cash flow estimates are realistic. That is, the company is going to earn them. Those cash flow, the actual will be the same thing. That's our assumption. So the cash flow estimates are realistic and we occur at the end of each year. Okay. So that's our assumption under cash flow. Then number 2 assumption. In the question, you are given sunk cost. Before we talk about sunk cost, anytime in a question, if you are given cost of capital, you talk about it. If you are given inflation rate, you talk about it. Any other cash flows you are given, any other assumption that you have made in the question, you also need to comment on them. So we can talk about inflation because of space. I've done working on that. So let me just close this one, making it 2. So we talk about inflation, for example. So what assumption have we made on inflation? So you can say that the inflation rates are assumed to remain constant. Within the relevant range. That is, during the period of these contracts or during the period of this project, the inflation rate will not change, will not increase, because once the inflation rates increase, certainly it will affect our decision to accept the project. So our assumption is that inflation rate will remain constant within the relevant range or within the period under consideration. That's for that. Then number 3, we can talk about our cost of capital. Okay. So what's our assumption under cost of capital? It's assumed that we have used money cost of capital for money cash flow. So that means our cost of capital is consistent with the cash flow. So I can then say it is assumed that the cost of capital of 11% is consistent with the risk associated with the project, with the risk associated with the projects and the cash flow, money cost of capital for money cash flow. Then number 4, we can talk about sunk costs. Sunk costs. You know, in this question, in the first paragraph, you are given development cost and the market research cost. We say they are sunk costs. Therefore, I would then say the development costs of 8 million naira and the market survey, market research costs of 2.5 million naira are sunk costs. And therefore not relevant to the calculation. Are sunk costs. Let me see if I can manage it. Are sunk costs and not relevant to the calculation. That's it. These are our assumptions in the calculation. And that's what the examiner is expected of. For you to be able to earn your full mark, you have to do it this way. All right, you have to let the examiner know the reason why you ignore some figures in the question. All right, so that is that. Then number C, part of the requirements. Okay. Yeah, examiner. Oh, okay, that's even number C. Yeah, what we just did is the number C. What are your assumptions on the calculation about 5 marks? So it's good that, okay. So you can see, I didn't even know that we are asked. So whether you are asked or not, it's important that anytime you have done calculation like this, you just have to state your assumption so that you don't lose valuable marks. Assumption is not something you are going to fabricate. It's there in the question for you. How have you arrived at your numbers? That's what the examiner is asking you to do. Okay, so that's end of the question. Let me know if you have any question for me so that we can, let's see if we can solve one more illustration before we close the class. Okay, so let me stop sharing this. Let's see, we can add one more illustration. So that will reduce our stress subsequently. Okay, so let me see. Okay, in that case, let's go to illustration number 1. Let's solve this illustration number 1 that was avoiding before.
See my wrist.
Yes, Charity, since you like to talk, yeah, read the question for us.
Oh,
Yeah, that's a prize for disrupting my class. Yeah, talk. Yeah, read.
True Talk Nigeria Limited is a fast-growing profitability company. The company is based in Lagos and has just won a contract to supply gas to the State Electricity Board. In this regard, the company plans to commission a 35-kilometer pipeline at a cost of 260 million naira to enable it to execute the contract. The pipeline, when installed, will carry the gas to an agreed location under the control of the State Electricity Board. With all these arrangements in place, it is expected that the sales of the company will increase from the present 360 million naira to about 1.1 million
1.1 billion.
1.1 billion naira. The anticipated revenue from sales to the sales to the State Electricity Board is expected to be 120 million naira per annum. Apart from this contract, the pipeline could also be used to transport liquefied natural gas (LNG) to other willing customers in the suburb. The sales from this source are put at 8 million naira per annum. The management of True Talk Nigeria Limited considers the useful life of the pipeline to be 20 years. The financial manager estimates a profit to sales ratio of 20% per annum for the first 12 years and 17% per annum for the remaining life of the project. The project is not likely to have any salvage value. True Talk Nigeria Limited is located in a remote area, hence would enjoy exemption from tax. The company's cost of capital is 15%. You are required to distinguish between mutually exclusive investment and independent investment. B. Why is investment decision important to organization, and what technique can be used to ensure that optimal investments are undertaken by firms? C. What is the project payback period? D. Advise True Talk Nigeria Limited giving reasons to as the acceptability of the project based on the payback criteria. E. Compute the project NPV and IRR.
Yeah, thank you very much, Charity. That is the question. Now, the first requirement says you should distinguish between mutually exclusive investment and independent investment. When I was explaining the concept, I mentioned this to you. I could remember when we finished discussing the NPV under the decision rule, I told you, note, independent projects to mutually exclusive projects. It's the same thing examiner is asking you here to distinguish between mutually exclusive investment and independent investment. So what are you supposed to say? The mutually exclusive investments are competing investments in which the acceptance of one will preclude the acceptance of the other. For example, if investment A and B are mutually exclusive, the acceptance of investment A will result in the rejection of investment B and vice versa. I would then say on the flip side, independent investments is a standalone investment that may be accepted or rejected based on its own merit. For example, if the investments produce a positive NPV, it will be accepted. But if negative NPV, it will be rejected. So that is what you are supposed to say. It's not sufficient for you to just explain what is mutually exclusive, what is independent investment. You have to give an example for you to be able to earn your full mark. So that is as per that. Then number B, examiner is asking you, why is investment decision important to organization and what technique that can be used to ensure that optimal investments are undertaken by firms? Examiner is simply asking you, why is investing decision important? What is the significance of investing decision? Why do you carry out investment decision? The essence of investment decision is to determine the financial viability of the investment. You want to know whether the investment is financially viable. All right, that's why you are carrying out investment decision. So examiner is now asking you what techniques can be used to ensure that optimal investment decisions are undertaken. You then say the techniques that can be used to ensure optimal investment decisions are undertaken include net present value, internal rate of return, payback period, adjusted present value, accounting rate of, you just mention few techniques, then you say etc. That's what examiner is asking you in that B part. So I repeat, examiner is asking you, why is investing decision important and what techniques that can be used? So investment decision is important in order to determine its financial viability. So the other parts, what techniques? The techniques that can be used to ensure that optimal investment decisions are undertaken by firms include net present value, internal rate of return, modify internal rate of return, payback period, etc. You have answered that. So you move on to the next one. Number C, examiner is asking you, what is the project payback period? So this is where you have calculation. You want to calculate payback period. And I told you that payback period is the period usually expressed in years in which it takes cash inflow to equate cash outflow in capital investment. Of course, payback period is a measure of liquidity. You want to know how quick, how soon can the company recover the initial investment. So in this particular question, you are given an initial outlay of 260 million naira. Examiner is now asking you, when is the company going to recover the 260 million? That's your payback period. What are you supposed to do? In my explanation to you, I said that whenever you want to calculate payback period, you need cash flow. So meaning that if accounting profit is given to you, you need to convert it to cash flow. So in this question, the cash flow given is not direct. So you are going to do some workings before you get your cash flow. All right. So first thing first that you need to do, as far as this question is concerned, is to bring out all the relevant variables that you need, all the relevant variables that you can see in this particular question. You bring them out. So quickly, let's do it together. I will stop sharing this so that I can go to the working notes. We have limited time to complete this. Okay. Solution to illustration number 1. Still on, I think that's page 45. Or it's still page 46. Let me confirm. Page 45. All right. So, yes, the name of the company is True Talk Nigeria Limited. Number C, requirements. You have to calculate payback period. I would then say calculating payback period. Please don't do this on the day of your exam. You have to write it out in full first, at least on the first instance. Payback period must be written out in full. So, I will use this page for payback period, NPV, then internal rate of return. My working will start here. So, working. Now, I need to bring up all relevant variables. Let's be fast a little bit so that we can complete within time. All right. So based on the first paragraph given to us, initial outlay is 260 million naira. So let's bring out all the variables that we need in the question. So here is initial outlay to be 260 million naira. Then, still in the same paragraph, you are told that it is expected that the sales of the company will increase from the present 360 million naira to about 1.1 billion naira. So the fact that your sales has increased from 360 to 1.1 billion does not make that to be your sales value. All right. So the examiner is just telling you that sales has increased. That's not what I'm looking for. I need the sales, the anticipated sales or the expected sales or projected sales. So in the second paragraph of the question, examiner told you that the anticipated revenue from sales to the State Electricity Board is expected to be 120 million naira per annum. So let's put it down. So we have revenue. These revenue are from two sources. One from the state's electricity board. The revenue at this source is 120 million naira per annum. Also, in the same paragraph, you are told that apart from these contracts, the pipeline could also be used to transport liquefied natural gas to other willing customers in the suburb. The sales from this source are put at 80 million naira per annum. Okay, that's another revenue from LNG, 80 million per annum. Okay, so what else? Any other revenue? According to the question, the management of True Talk Nigeria Limited consider the useful life of the pipeline to be 20 years. Okay, so there's no other revenue again. So I will add up everything. Here is 200 million naira per annum. That's the total revenue. Total revenue is 200 million, okay, per annum. Then also in the question, we are told that the useful life is 20 years. To get the NPV, to calculate NPV, we need about three variables. One is useful life, appropriate cost of capital, and then relevant cash flow. So again, according to the question, after useful life, we are told that the financial manager estimates a profit to sales ratio of 20% per annum for the first 12 years and 70% per annum for the remaining life of the projects. So, profit to sales ratio, another name for profit to sales ratio is contribution margin ratio. All right. So, what the examiner is simply telling you there is that contribution to sales is 20%. So, in this case, I would then say contribution. Okay, contribution for the first 12 years. So year 1 to 12, contribution is equal to 20% of the total sales of 200 million. This will give us 40 million naira per annum. Then for the remaining years, which is year 13 to 20, remember, useful life of this project is 20 years. So from year 13 to 20, profit to sales ratio is 17% of the total sales, total revenue, which should be 34 million naira per annum. Okay, so I've treated that, I've brought out that information. Next one, the project is not likely to have a salvage value, so scrap value is 0. True Talk Nigeria Limited, so that information is not needed. Company's cost of capital is 15%. So I would then come here also, cost of capital is equal to 15%. So these are the variables given in the question. Now, these are I've summarized all the information given in the question. You now want to calculate payback period. So I can see the initial outlay to be 260 million. The cash flow I'm going to use in this case, the cash inflow is no more 200 million. Examiner has given me contribution of 40 million per annum, 34 million per annum between, the 40 million is between the first 12 years, all right? Then the remaining, the 34 million is for the next 8 years, that is from year 13 to year 20. So first thing first, if I like, this is the approach you are supposed to use to calculate your payback period on the day of your exam, if you have this kind of a question. Now, you know that this cash flow of 40 million naira per annum is constant from year 1 to year 12. So by the time you multiply 40 million multiplied by 12, that will give you 480 million naira. which means that the initial outlay of 260 million naira is within the 12 years. I repeat, we are told that our contribution is 40 million naira per annum for the next 12 years. So I want to know what is the total contribution for the first 12 years. So that will be 40 million naira multiplied by 12 years. That will give us 480 million naira. And our initial outlay is 260 million naira. So that means our payback period is within the first 12 years. So if that is the case, I can then say my payback period, I can come here to say payback period is equal, since my cash flow of 40 million is constant for the next 12 years, I will say payback period is cash outflow over cash inflow over constant cash inflow. Whatever you have, you express this in years. Okay, so payback period will then be equal to, the cash outflow is 260 million naira divided by the constant cash inflow of 40 million for the next 12 years. So when you do this, we are going to have payback period is 6.5 years. So now, instead of me to be doing it 1-1, so you are not supposed to be doing that. It's a waste of time. Say, for example, if you want to use the tabular method, so you create a column for year, cash flow, cumulative, okay? Starting from year 0, year 1, year 2, year 3. You can't be doing this one from year 1 to 20. It's a waste of time. Year 4, year 5, year 6, year 7. Continue like that until you get to year 12. Year 13, year 14, blah, 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 until you get to year 20. You can't be doing this. The cash flow for year 0 is 260 million. Year 1 is 40 million. That 40 million is constant for the next 12 years. 40, 40, 40, 40, 40, 40. You continue the 40 until you get to year 12, which is still the same thing as 40. Then from year 13 to 20 is 34. 34. You continue like that until you get to the final one, which is 34. So to now recover the 260 million that I've invested, so I will say 260 minus 40 will give me 220. 220 minus 40 will give me 180. 180 minus 40 will give me 140. 140 minus 40 will give me 100. 100 minus 40 will give me 60. 60 minus 40 will give me 20. I said that when you get to a point where your outstanding cash flow, when your outstanding balance is less than the next cash inflow, you put a dash because 20 million is less than the 40 million. In this case, you then calculate your payback period. You then say payback period equal to how many years have you recovered? We have recovered for 6 years. Year 1, year 2, year 3, year 4, year 5, year 6. So here will be 6 plus the outstanding balance of 20 divided by the next cash inflow of 40. So that means your payback period is equal to 6.5 years. So why do you want to be going through all this stress? To be doing year 1 to 20, be doing it like a primary school student, when you know that you can do it using formula and then move on straight. All right. So you need to shine your eye. You need to shine your eye. So what I did in this calculation is that I know that my cash inflow is constant at 40% for the next 12 years. So, and the initial outlay is 260 million naira. So I will multiply the constant cash inflow for the first 12 years by the number of years, which is 12 years. That gave me 480 million. So since the initial outlay is within 480 million, then I will use this formula to get my answer because I know that my payback period will fall within the 12 years. That's what I've done. But if you don't know that kind, if you can't figure it out like that, then you need to do it like a primary school student, like I've done here too. Just list it from year 1 to 20. If you are still doing this one, your colleague that knows that know his or her onion has gone to the second question. You are still doing this one. You are happy because you are taking your time. It's all right. So that's how to calculate payback period on this particular question. So the next requirement says you should calculate, you should advise True Talk Nigeria Limited given reasons as to the acceptability of the project based on the payback criterion. Again, when I was explaining the concepts, I mentioned to you that the decision rule for payback period is that for independent projects, you accept if payback period is shorter or equal to management predetermined payback period. For mutually exclusive projects, accept any project with a shorter payback period, provided it is equal to or less than the management predetermined payback period. In essence, whenever you calculate payback period, you need to benchmark your calculated payback period with the management targeted payback period. And I said that when management targeted payback period is not given to you, there will be no basis for the acceptability of the project. So in this particular question, examiner is asking you to advise on the basis of payback period and give reason for the acceptability of the project. So what you are supposed to say, since in this question you are not given management targeted payback period, so this is what you are going to say. The project will pay back. Okay, the project will pay back, or the company will recoup. The company will recoup or recover, will recoup the initial investments of 260 million naira within 7 years. That is 6.5 years. Okay. However, in this question, we are not given the management targeted payback period, so there's no basis. However, since management targeted payback period is not given, there is no basis for the acceptability of the projects. That's it. That's all you need to say. Because you don't benchmark your calculated payback period with the useful life. It has to be based on the management targeted payback period. So since you are not given, you don't have anything to benchmark against. So that's simply that. That's how to answer the requirement number D. Finally, requirement number E, you have to calculate NPV and then internal rate of return. This is straightforward. So number E, Roman figure 1, calculating NPV, net present value. How do you calculate net present value in this case? Very simple. All right, this is not you are not given multiple variables. So I'll just come here, NPV, create a column for year, description of items, cash flow, discount factor. We are given cost of capital of 15%. Then present value. Our figures are in million. Okay. Year 0, year 1 to 12, then year 13 to 20. All right. So here is initial outlay, annual contribution. Initial outlay is 260 million naira. The annual contribution is constant at 40 million for year 1 to 12. and 34 million for year 13 to 20. So we need to go and calculate annuity factor. Okay, we need to calculate annuity factor of years 1 to 12 and then years 13 to 20. Let's go and do working for annuity factor. So I will then come here, annuity factor, AF. You know that annuity factor is calculated as 1 minus 1 plus R raised to power minus N divided by the company's cost of capital. So at 15%, so you need to do for years 1 to 12. To get annuity factor of year 13 to 20, so you need to first of all calculate annuity factor of year 1 to 20. Then you calculate annuity factor of years 1 to 12. Let me write that. Years 1 to 12. Then the difference will then give us annuity factor of year 13 to 20. So to get the annuity factor of year 1 to 20, this will be 1 minus 1 plus R. I don't need, I already have the formula. So that's one, at 15%, that will be 1.15. Useful life is 20 years minus 20. Okay, divided by discount factor is 15%. So what do you have there? Give it to me quickly. Who is helping us?
6.259.
6.259. Then I need to calculate annuity factor of years 1 to 12. So that will be 1 minus 1.15 raised to power minus 12 divided by 0.15. Give it to me. What do you have?
5.421.
421. So what's the difference?
0.838.
0.838. So that will give us annuity factor of year 13 to 20. So whenever you want to do, we have done similar thing under cost of capital. So whenever you have and you want to calculate annuity factor in between years, so this is how you are going to do it. You start from year 1 to 20, then less the one of year 1 to 12. So to get the annuity factor of years 13 to 20, just minus get the minus the year 1 to 12 annuity factor from year 1 to 20 annuity factor. So that's that. So let's go and post 5.421. 5.421 here is 5.421, 0.838. So let's get the present value quickly. What's the present value? What's the present value? Right? Let me multiply myself. So 34 multiplied by 0.838 equal 24.49, 28.49 rather. So rounding. So let's say this is 28. Let's round the number. That's 28. Then 40 multiplied by 5.421. That's
216.
216. Here is
84.
217. That's 217. 217. So 217 plus 28, that's 245 minus 260 minus 15. Okay. So this is how to calculate NPV for this project. Now, the second part, the last part, we have to calculate internal rate of return. And you know that whenever you want to calculate internal rate of return, you assume two discount rate that will produce two opposing NPV. Therefore, because I've calculated NPV before at 15%, I got a negative NPV. So I will assume 10% to get a positive NPV. So number E high, calculating internal rate of return. So we want to assume 10%. Again, I've explained to you severally, whenever you are calculating internal rate of return, you are the one that will assume the discount rate to be used. All right. So you then use the assumed discount rate to calculate NPV, cash flow, discount factor at 10%. Then present value. Sorry, this is about 10 minutes after. Just give me additional 5 minutes to finish this. Year 0, 1 to 12, 13 to 20. We're almost there. Here is initial outlay, contribution, 260 million, 40 million, 34 million. So we need to go and calculate annuity factor of years 1 to 12 and then year 13 to 20. So annuity factor at 10%. This is at 15%. Let me make it clearer. Okay. So I will do for years 1 to 20 first, which is going to be equal to, we are assuming 10%, so that will be 1 minus 1.10. Let me clean that. 1.10 raised to power minus 20 over 0.10. What do you have there? Minister of Finance, are you still there with me?
8.514.
8.514. So I will then calculate annuity factor of years 1 to 12. Okay? That will be 1 minus 1.10 raised to power minus 20. Sorry, minus 12 rather. Minus 12 divided by this cost of capital of 10%. What do you have?
6.814.
814. So minus that. What do you have?
1.700.
1.700 is the annuity factor of year 13 to 20. Let me rewrite it. Year 13 to 20. So that's that. So 6.814. 6.814 is from year 1 to 12. 6.814, 1.700. Let's multiply. Okay. So here will be 34 multiplied by 1.7 equal 58. 58 rounding. Then 40.
272.56.
273. That will be 272.56. So that's 273. So 273
71.
plus 71 is the difference, right?
Yes, sir.
So here is 71 positive. All right. So we assume 15% discount rate. We got a negative NPV of 15. We then reduce it to 10%. We got a positive NPV of 71. At this point, I will then calculate internal rate of return. So I will then say IRR is equal to A plus NPV of A over NPV of A plus net present value of the higher discount rates. Higher discount rates minus lower discount rates. Okay, no space again. So let me just manage it. So IRR would then be equal to A, we assume 15 and 10%. 10% is lower. So 10 plus NPV of the 10 is 71 divided by 71 plus NPV of higher discount rate of 15. Okay. So higher discount rate of 15 minus lower discount rate of 10. Final answer. So 71 divided by 86. 71 divided by 86 equal multiplied by difference between 10 and 5, which is 5, equal plus 10 equal, that's 10.13%. Okay, that's 10.13. What am I saying? 14 points. What did I have? 14.13. Here is 14.13%, which is consistent with the NPV. This is approximately 14%, which is consistent with the NPV. You recall that when we calculated the NPV, we got a negative 15. So we got a negative NPV of 15. If you want to advise on the basis of NPV, you know this is not viable because this is a negative NPV. The same thing, if you want to use internal rate of return as a decision criterion, you need to benchmark your calculated internal rate of return with the company cost of capital. The company cost of capital is 15%, but the internal rate of return calculated is 14%, which means it's lower than the company cost of capital. It means the project is not financially viable. So when you have independent projects, all right, or independent investments, the decision of NPV will always be consistent with the decision of internal rate of return. It is only under mutually exclusive projects that the two of them may be conflicting. So that's end of the question. Let me know if you have any question for me so that we can close the class. All right. Any question? Yes, Minister of Finance, talk to me briefly.
Under exam condition, the requirements E said we should compute both NPV and the IRR. Will examiner assume, or are we supposed to assume that since we've calculated it above, there's no need doing it under the requirement itself?
No, Shabi, it's the same thing we did there.
Yes.
In our E, you've already calculated 15%. E2, you want to calculate internal rate of return. So this is the way you are supposed to do it now. You are not assuming anything again, except if I don't get your question correctly.
Oh, okay. Yes, it's true. I'm good.
We are not saying, when we are calculating the internal rate of return, we only assume 10%, Abi, because we have calculated NPV before. And that's why we calculated the first NPV. We got negative 15. We now say, okay, we want to use that 15% as one of our discount rates for internal rate of return. We now reduce the 15% to 10% discount rates, and we got positive 71. So in this case, we're assuming 15% discount rate and 10% discount rate for our internal rate of return.
Okay, so we don't have to draw another table for IRR again. I'm okay,
Another
sir.
table. Okay.
Sir, this request, I think it will happen where they did not ask you to compute NPV. That is where you
Yes.
to
So if in the question now you are not asked to calculate, you are just asked to calculate internal rate of return. So you have assumed 10%. This 10% is positive 71. So you need to increase your discount rate to get a negative NPV. So in this case, when you increase to 15%, you also get a 15% NPV negative. Then you're good. But like in this particular requirement now, the first one is to calculate NPV. You've calculated NPV to be negative. That means you need to assume a second discount rate that will give you a positive NPV. Yeah, that's what we have done. So any other question? Any other question? Okay. So in the absence of no further question, this is where we are going to call it a day. I want to say thank you to every one of you for waiting behind, even though it's already past 19 minutes past the normal time. I appreciate your patience. I will see you next time by the grace of God. Good night, everyone.